Hello, everyone, and welcome to our latest webinar session, Upcoming Tax Changes for 2026, How Will They Impact You? With Wealth Enhancement Group, my name is Tom Bittinger. And before we get started, I want to go over a few housekeeping items. One, there will be a Q&A session at the end of the presentation. So if you have any questions, feel free to submit them using the questions pane in the GoToWebinar menu, and we'll get to as many of those as we can. And as always, we are recording today's session. So if you miss something, if you have to step out for a second, don't worry. We'll send out a recording in the next few days. So be sure to check your email for that, and follow-ups to any future webinars as well. So jumping into things, with me today is Kate Maier, Vice President of Private Client here at Wealth Enhancement, and Joseph Guy, Director of Insurance. They're both based out of our Plymouth, Minnesota headquarters. And these two are very well educated, very experienced members of our roundtable, and I'm just going to let them take it away from here. So Kate, Joe, take it away.
So as we start off the webinar today, I figured I would just kind of cover a little bit of the tax laws that kind of have gotten us to where we are today. And also just as an example of the fact that tax laws have been changing pretty regularly over the past, almost 10 years now. So just kind of to start, in the 2017 in December, a lot of tax laws you'll notice will have passed in December. The Tax Cuts and Jobs Act passed, which is what we're going to focus on mostly today. And that's when the income tax rates were dropped for individuals, actually also for businesses, but we're going to be focusing on individual tax rates today. And estate tax rates were almost doubled in 2017, all starting as of January in 2018. And then in 2018, we had a lot of changes in state income and in state tax laws. So it didn't necessarily affect you personally. Maybe your state didn't, but other states did because they were trying to coordinate their tax laws with the new federal law. And then in 2019, we saw the Secure Act pass, which I think the biggest outcome of the Secure Act was the change in beneficiary IRAs and no longer being able to stretch RMDs over a lifetime, but instead having to get them out within 10 years. And then when we saw COVID in 2020 and 2021, we saw a lot of stimulus bills that added a lot of temporary tax changes, increased credits, things like that. And then 2022 was a Secure 2.0, which kind of built off of some of the laws that were passed in 2019 with the Secure Act. And then not on here, but what we're going to discuss in more detail today is the fact that in 2026, if nothing changes between now and then, we're going to be going back. A lot of the individual tax cuts and changes in the 2017 Tax Cuts and Jobs Act are going to expire, and we're going to go back to what taxes look like in 2017. So what was in the Tax Cuts and Jobs Act? As I mentioned before, it was passed in December of 2017. So this was a tax law that took place in 2018. It reduced tax rates for individuals. So those of you who found yourself in the 25% tax bracket in 2017 are now probably in the 22% bracket. Those are in the 28% bracket then are probably in the 24% bracket now. So they basically took most of the tax brackets and reduced the tax rates within those brackets. They raised the standard deduction and basically doubled it. So a lot fewer people within these past few years have been itemizing their deductions just because the standard deduction is so much higher. It increased the tax and other dependent tax credits. So some credits you're getting now will probably go away in 2026. It greatly increased the thresholds for the alternative minimum tax. So a lot of people used to have to deal with the AMT in 2017 and before. Not very many people have had to do it within, since 2018. That's probably going to come back into effect in 2026. And then, as I said earlier, the federal exemption, the state and gift tax exemption, it basically doubled. So really nothing else with the estate taxes changed. We still have the same 40% tax rate, same annual exclusion gifts, but the exemption itself doubled since 2018 through 2025. And then what's changing in 2026? So unfortunately, in order for Congress to be able to pass the law in 2017 to get with 51 votes in the Senate, they had to arrange it in some way so that it didn't negatively affect the federal budget over 10 years. And so a lot of those individual tax brackets and tax changes that happened in 2018 had to expire in order for them to be able to pass it the way they did. So that means the income tax rates and brackets are going to go back to 2017 levels. So again, if you're in the 22% bracket, you're probably going to find yourself back at the 25% bracket. Those in the 24 will find themselves in the 28. The standard deduction is going to drop again. But on the other hand, you can see that there's a limit on state and local income tax deductions right now, which they limit at $10,000 per tax return. That's going to go away. There's going to be no cap anymore. So those of you who live in high income tax states probably going to be able to deduct those again. The AMT exemption is going to drop again. So a lot of you are going to find yourself in AMT, and child and other dependent tax credits are going to go down. And then the federal estate tax exemption amount, that's going to drop roughly in half. So it was around just over $5 million in 2017. It'll still have inflation adjustments in 2026. We're assuming it's dropped somewhere around 7 million again in 2026 if nothing happens. So now I'll pass it on to Joe.
Thanks, Kate. And so I'm going to hit more of the individual tax changes in a little bit more detail than Kate just covered. So at a glance here, you're seeing the income tax rates for individuals. These are individual tax rates. You can see on the current side where the tax rates are lower line by line at 10, 12, 22, and 24%. So on average, they're about either 2 to 4% lower in comparison to the right chart, which is the Post-Tax and Cut and Jobs Act. So that's the reversion back to the 2017 tax brackets. So on the right-hand side, you'll also notice that the range or the income ranges are lower, and these on the right-hand side have not yet been fully adjusted for inflation. So we expect them to mirror or get closer to the current income tax rates and the ranges, but we won't know that until 2026. So they should adjust to inflation, but at the very least, when you look at them in comparison, the rates are less in today's income tax chart. So anywhere from 2 to 4%, depending on which bracket that you actually fall into. And then when we talk about long-term capital gains, that's my insurance brain, you can see that there's still the 0, 15, and 20% brackets. And lo and behold, or for the most part, this hasn't really changed. Where you fall on the tax brackets and where your income falls are pretty much in line with the 0 and 15 and 20% that they were in 17, adjusted for inflation. Again, on the right-hand side, we don't know what the adjusted 2026 rates will look like or the brackets will look like, but in the most part, the 0, 15, and 20% capital gains or long-term capital gains rates are going to stick, and not much change is going to happen there. So when we look at the standard deduction, as Kate mentioned earlier, it almost doubled. It more than doubled, actually. And this has been adjusted on the left side for inflation. So right now, if you're married filing jointly, you get over a $29,000 tax standard deduction. And so that really eliminated a lot of people from itemizing their deductions. And it made it simpler to file your tax return. Who it did affect the most are most of the East Coast and West Coast tax filers, because they usually got a pretty large SALT deduction or state and local tax deduction for their property taxes. But that was capped at $10,000 as a couple, or $5,000 per individual. So that significantly impacted the East and West Coast, higher cost of living areas that have high property taxes. And so that will come back. The SALT taxes will come back, and certain itemized deductions like itemizing your investment fees will come back as well in 2026, but you're also losing the larger standard deductions that we've currently experienced. So you'll probably itemize more in 2026. You'll be able to take some of your interest on your primary mortgages and home equity lines up to certain limits that are a little higher than what we have today. So at the end of the day, the itemized deductions will probably help those on the coast, but not so much in the Midwest and the center of the country. And then from the alternate minimum tax, as you know, this was created to kind of tax higher income taxpayers. So there's two ways of calculating what you would owe. And if your regular income tax rules were superseded by the AMT, you would end up paying more in AMT. It was actually in 2017, about 5 million taxpayers were affected by the AMT. And consistently since then, from 2018 to now, about 200,000 taxpayers are affected by the AMT. So that's been that saved a lot of taxpayers money by not having to pay the AMT, but this will come back in 2026. And right now, the estimates are going to be that it'll affect about 9 million different taxpayers. And so when you look at the brackets, the reason why so many have saved on not having to pay the AMT is because the threshold or the exemption phase outs were raised so high, that $1.2 million for married filing jointly. You can see the exemption amount starting at 133,000 versus the 84,000. So that's actually helped save people on not having to pay the AMT tax as of late. But this will phase out in January of 2026 and could affect upwards of 9 million tax filers at that point. So what are some of the things that we could do? We could bring income forward. So think about if you're taking advantage of a traditional 401k, maybe it's worth taking advantage of the Roth 401k option and actually paying the tax on today's income. You might want to take on and maybe liquidate some capital gain positions to pay the tax today versus tomorrow, just based on brackets alone. You might want to take advantage of Roth conversions where you'll pay taxes today in a lower tax bracket, so that you're not in the higher tax bracket tomorrow when you end up withdrawing those IRA or qualified assets. And if you have the option maybe to defer income today, maybe your employer is offering a deferred comp strategy or something of the sort, maybe don't defer that income. Maybe take advantage of liquidating your stock options that you have available today instead of waiting a little longer. So really start thinking about how you could incur more of the income today in the more favorable tax brackets that we have, as opposed to waiting till tomorrow. So the big change and really where we're going to focus the rest of our webinar today is that the federal estate tax exemption is going to have a pretty significant decrease of what you're allowed to take advantage of today versus tomorrow. So when we think about basic estate tax planning, you think about having a will, and believe it or not, over 68% of Americans don't have a will or an updated will. Their wills are out of date or they don't have one at all. So that's pretty surprising. Trust planning, it could be simple trust, right? It doesn't have to be a complicated trust. So definitely taking advantage of trust to make sure your assets are left to the right people at the right time will make sense. Durable powers of attorney. This is a legal document that allows someone to step into your shoes financially and make financial decisions on your behalf if you're incapable of doing so. If they are a durable power, they can do it at any point. You don't have to necessarily be incapacitated or unable to make those decisions. There's many different types and variations of those powers of attorney. A living will or healthcare directive. So you could give a health proxy to a loved one or someone that you trust to help make health care decisions on your behalf if you're incapacitated. And then believe it or not, beneficiary designations. I'm in the insurance industry here as the director of insurance. We see a lot of old life insurance policies that have the wrong beneficiaries named on them. Could be ex-spouses, could be an old business partner, could be children that maybe you don't talk to, or maybe it's children that you've added to your family and you haven't thought about all the children that you now have, maybe from a second marriage or having children later in life. So there's definitely reasons to review all things that have a beneficiary tied to them, and also to note that anything that has a beneficiary designation passes outside of probate and your will. So that's important to note, because they'll pay whoever's named on that policy, whether it's an ex-spouse or not. And then getting into the more advanced estate planning, especially when there's an estate tax to be considered. So in 2017, our individual exemption amount was about $5.49 million. And in 2024, that's at 13.6 million. So as a couple today, you could protect or shield over $27 million of your assets from the federal estate tax. So if you passed away today with $27 million, you wouldn't owe any taxes to the federal government for estate taxes. In 2026, that'll revert back to an inflation adjusted around $7 million. So that 5.49 million over the last 9 years will adjust to about 7 million is what we're anticipating. So as a couple, you'll only be able to exempt $14 million of assets. So it's cutting your exemption pretty much in half from where it is today. And so we want to really make sure that we're taking advantage of that exemption in a way that when I show you kind of this example, if you're a married couple with $20 million of assets today and you passed away, you would owe no taxes. There would be no taxes owed. But if you passed away in 2 years from now, in 2026 or later, you would now owe over $2.4 million, just simply because of that exemption coming down or being cut in half. So there is a cost of waiting. There is a cost of not doing much in planning. So we're encouraging everyone to start thinking about planning on a larger scale, especially if you're in that high net worth bracket. But for anyone should be doing estate planning, making sure your wills are up to date, you have the proper legal documents in place. And from here, I'll pass it along to Kate so she could go into more of the planning techniques around the federal estate tax.
So first, I'm going to talk about kind of the different groups of people who might be affected by the reduction in the estate tax exemption amount. So first, there are those of you who are already subject to estate taxes. So those for individuals, your estate is over around 14 million. And for a married couple, you're slightly over 27 million. So you are going to pay an estate tax even if you both died today. So we're hoping that you've already done at least some basic planning because just to at least help avoid current estate taxes, but you may want to go into more detail or do more things to help lock in those higher exemption amounts today before they drop. The people we're probably most worried about are those who are currently not subject to estate taxes, but will be in 2 years. So if you're an individual, you're somebody with an estate between about 7 and 13 million, or if you're married, your total estate is between about 14 and 27 million dollars. So those of you in that bracket, we're thinking if you've done planning, it's probably been a lot more simplistic because you haven't had to worry about estate taxes. Going forward in a couple of years, if you don't do any planning right now to help either lock in the exemption or take gifting, do anything in basic planning, you might be increasing your estate tax liability in 2026 and beyond. And then there are those of you who probably aren't subject to estate taxes now, but you're high earners and you're likely sometime in the future going to be subject to those taxes. So you probably don't need to act right away. There might be some things you might want to do to take advantage of today's laws before they drop. But if you don't do anything, you're not going to be in as bad of a situation as those first two groups who are going to be subject, who are either currently subject or going to be subject to estate taxes. So that's for people, individuals are making, over $300,000 a year. You already have about $1 million in investable assets or more. Married couples, we're thinking of you more like $500,000 a year with $2 million investable assets. Something this particular group of people will need to worry more about is if you live in a state with an estate tax or inheritance tax. So I'm from Minnesota. You're going to be subject to estate taxes in Minnesota here with an estate over $3 million. If you live in Oregon, your estate only has to exceed $1 million before you're subject to state estate taxes. So while you might not need to act to help avoid federal estate taxes, you might need to be doing something to make sure you're avoiding those state estate and inheritance taxes. And then there's that other unknown group. So you're the ones who have hard to evaluate assets. So you're business owners. It's a very illiquid asset, but most of your estate is in that. You don't know exactly what it's worth. And if you're to die and were subject to estate taxes, you wouldn't have the liquidity to pay those taxes. Same with real estate. That's a little bit harder to value. And it's also very hard to liquidate quickly if you need to pay estate taxes. And then those of you who are blended families, you're less likely to be able to kind of move your assets around because you want to make sure that your assets go to your kids, even though you're taking care of your spouse if you're to die first. And then something not on that list is also people who have non-US citizen spouses. There's probably some additional planning you need to do there because of the treatment of what we call the unlimited marital deduction, which I'll go into more detail a little bit later in the presentation. So we're going to kind of do a quick, very quick, going through 8 different strategies to consider. I'll be talking very high level about these. We're not going to have enough time to go into a whole lot of detail, but if any of these kind of are interest to you, reach out to your financial advisor and or to your attorney and just figure out if they make sense to you, and then you can get a little bit more in depth about how they would work, particularly for your own situation. So the first thing you want to do, if we can move ahead here, there you go, thank you, is just to make gifts. So the more money you give away in your life, obviously the lower your estate is going to be at death. So the first thing to do that anybody who has a high net worth estate or high estate want to consider is taking advantage of those annual exclusion gifts. So an annual exclusion gift is the amount of gift that one person can give to one recipient in a given year without having to worry about federal estate or gift tax issues. And so one person can give $18,000 this year to however many people they want to. So it's not 18,000 total, it's 18,000 per recipient. So the more people you're giving 18,000 to, the more you can reduce your estate in 1 year without any estate or gift tax issues. And then even if you're not really, your estate is still growing, making those gifts can also, slow down the growth of your estate. So hopefully you can reduce your estate tax a little bit in the future. Another thing you can do is make lifetime gifts. So you sometimes might hear us talk about the unified credit. That's the estate and gift tax. You can either give it away during your lifetime, you can give away up to $13.61 million this year, or you can give it away at death. You can't give it away both. So they call it a unified credit. So if you use it during your lifetime, you reduce how much you can use at your death. So that's kind of what we're talking about with the unified credit there. So for those of you who can afford to do so, you can give away up to $13.61 million this year without incurring any gift taxes and estate taxes, and you're locking in that high exemption amount. So if you died in 2026 and exemption dropped to $7 million, you've already given away $13.6 million estate tax free, and so you've locked it in. So those of you who can afford to do so might want to look into the possibility of making very large gifts right now, and I'll show you some ways in further slides on how you can do that without having to give the money to people outright. And then of course, always giving to charity is always going to be estate tax free. They're never going to charge you against your federal estate or gift tax. And you also get that additional benefit of having that, getting that income tax deduction if you do it during your lifetime. So kind of going on again, the gift topic. So one way you can give away that $13.61 million, it doesn't necessarily need to be the 13 million, you can give away, 7, 10, whatever, but in order to lock in the high exemption amount, you can take the exemption and put it into a spousal lifetime trust, which we call a SLAT. We really like our acronyms in the estate planning world, so you're going to see a lot of them in the next few slides. So what you do here is the donor spouse takes his or her own money, puts it in an irrevocable trust for the beneficiary spouse. So the donor trust gives away the money. He or she has no more direct access to that money. And then the trust terms are what dictate how the beneficiary spouse can access the funds. So, you can pay out all income. So any dividends and interest the trust generates has to be paid out to the surviving spouse. Or terms I see a lot used are health, education, maintenance, and support. So the trustee can make distributions to the beneficiary spouse basically to allow that spouse to continue living in the manner in which they're accustomed. And then the donor spouse has that indirect access to the funds via the distributions made to the beneficiary spouse. The one thing you need to be very aware of here is if the beneficiary spouse dies, unexpectedly, or if you get a divorce, that donor spouse loses all access to those funds. So you always want to make sure if you're going to make a gift like this that you can afford to not have access to those funds if something happens. The benefits of this kind of trust is once you put it into that trust, you use your exemption amounts. You don't have any exemption, or you've reduced your exemption by how much you put into that trust. But that trust, then all those assets are outside of your estate. And so, if if you live another 10 years after funding that trust and it grows $500,000, $1 million, that growth happens outside of your estate and is not subject to estate taxes. You can see you also take advantage of the higher exemption amount. You know, if you fund it now with the 13.6 million, you've locked in the exemption. So when it drops to 7 million, you've already given away the 13, almost 14 million without any gift tax issues. The spouse can have immediate access to the assets, again, via the terms that you put into the trust. It's very flexible, how generous you can be to the spouse. And like I said, again, the growth remains outside of the estate. So going on to this next slide is kind of a good picture of how a SLAT might work. So again, you can see that donor spouse is putting money into that irrevocable trust. We do recommend, you know, giving away around, 12, 13 million, just so you can lock in that exemption. And usually that donor spouse is also the one paying the income taxes on that trust. So by the trust not having to pay its own income taxes, you're actually kind of making a gift to the trust by paying its own taxes. So you're allowing more funds within that trust to continue to grow tax-free, or estate tax-free. And then the beneficiary spouse during his or her lifetime receives those distributions from the trust. You know, again, net income, and you can see that health, education, maintenance, and support. That's how most attorneys like to draft it. But if you want to be more restrictive or more generous, sometimes it's going to depend on what kind of trustee you name. But you can put more terms within that trust to allow the beneficiary spouse more or less access than that HEMS provision allows. And then upon that beneficiary spouse's death, remaining trust assets then go to your heirs. So it could be your children, nieces, nephews, family members, whoever. And so all of that passes estate tax free to those beneficiaries. And then you can keep it in trust for them so they can have the same distribution terms, again, the health, education, maintenance, and support. Or if you don't want them to have to deal with trust, you can also leave the assets to them outright. But basically, you are controlling, when you set up that SLAT, you are naming who those secondary beneficiaries are and ensuring that they're the ones that get the remaining assets of that trust when the beneficiary spouse dies. And then going on to number 3, so this is for people who maybe you don't want to give away so much money irrevocably into this trust. That, you know, what is this trust thing happening in? In that case, you can do a family limited partnership. So then you're putting your assets into this partnership. You can put investments assets basically into this business, and you can remain that general partner. And as a general partner, you maintain full control over those assets. So you can determine how they're invested, when and for what reasons distributions are made to the members of the FLP or the LLC. So you're maintaining control of that. And then you can also control kind of when you're giving ownership units of that FLP to your kids or to your other beneficiaries. And so in doing that, you can also, if set up properly, you can also make sure that those assets get some creditor protection that you wouldn't have if you kept those assets outright. Another big benefit of the FLP is that, particularly if you're one of those people, you have a business asset or real estate, something that is very hard to divide to different owners. If you put that into an FLP, all you need to do is gift FLP shares to your beneficiaries, as opposed to retitling that home into multiple beneficiaries. And so it makes it much easier to gift those illiquid assets that you'd otherwise would have to, divide up into different sections. And then with a big benefit of the family limited partnership is because you're maintaining full control over the assets. The limited partners, yeah, they own it, but they can't do much with it. They don't have any say in the running of that FLP. And if they're ever going to turn around and try to sell that to a third party, there's no third party person who'd want to buy that for full market value, because that person wouldn't have any control either. So you can actually usually take advantage of discounts when you're giving FLP units to your children or other beneficiaries. So just a very simple example, say you gave $1,000 in units to your child, but because you maintain control of everything, if your child wanted to go and sell that to a third party, they would maybe only be able to sell it for $700. So when you're reporting this gift on your gift tax return, while you're getting $1,000 out of your estate, you only have to report $700 to the IRS as a gift. And so it allows you to leverage your gifts. You can give more money away with less impact against your federal estate and gift taxes. The big drawback with the family limited partnership is you have to make sure that you're managing it as a company. So you can't continue to use those assets as other personal assets. You know, if you put a vacation home in there, you have to start paying rent to that FLP. You can't just continue to use the vacation home. Same with just investment assets. If you need to use the assets, you need to make a distribution from the FLP to your personal account, which might mean making distributions to all the members together. And then you have annual tax filings, annual meetings. So you still have all of those responsibilities of the business ownership in order to get the benefits of the FLP. But like again, since you maintain full control over it, that kind of helps negate some of those downfalls of having that FLP. Moving on to another way to make discounted gifts is the Qualified Personal Residence Trust, or we call it a QPERT. In this case, it needs to be, as it says in the title, a personal residence. So either, you know, your primary residence, or it can be a vacation home. You put that into an irrevocable trust for a specific term of time. So say you put it in the trust for 15 years. You then are able to continue living in that house for those 15 years. And because of the fact that you've maintained that right to live in the house, you get a discount for the gift of giving that house in the trust. So say you put $1 million house in that trust, you get to reduce the gift by about the value of your continued ability to live there for 15 years. So again, you're giving $1 million home away, but you're only having to report, say, $750,000 in a gift. And then say again that home appreciates to $1.5 million within those 15 years. That $1.5 million passes to your heirs, estate tax free, because you've already claimed a gift of $750,000. So you basically doubled your gift over the term of the trust for what you've reported it for. The downfall with this, which probably isn't really a downfall if you're trying to reduce your estate, is at the end of the 15 years, that house now belongs to your beneficiaries, which could be belong to them outright, or it could belong to a trust for their benefit. So it's no longer yours. You no longer have the right to live there. So if you want to continue living there, then you have to start paying rent to the beneficiaries of that trust. And so those rent payments then are another way to start getting assets to those beneficiaries. And it's not considered a gift because you're retaining the right to live there with the rent payment. So it's actually income to them. So that can be another big benefit of that QPERT. It's getting that home out of your estate to the people you want to leave it to anyway, while getting more assets to them as well. See, going on to number 5, if I can move ahead, whoops, let me move back. And then another Q trust, the Qualified Domestic Trust. So I mentioned earlier when I was going through the four types of people who might need to pay attention to this Tax Cuts and Jobs Act and the drop of the exemption, is for those with non-U.S. citizen spouses. So green card holders in particular get a lot of the same benefits as citizens. I mean, even when it comes to the estate tax, you still get that 13.61 million exemption, or the 7 million exemption in 2026. You can still give as much money outright to your spouse, an unlimited amount of money to your U.S. citizen spouse without estate tax issues. But unfortunately, the U.S. citizen spouse does not have that same privilege to be able to give an unlimited amount to a non-U.S. citizen spouse without estate tax issues. So the QDOT trust is the way to get around that. So by putting money into that QDOT, so first of all, the U.S. citizen spouse probably want to fund some sort of credit shelter trust with their estate tax exemption amount. But then anything above that, if they did not put it in the QDOT trust, they would have to pay the state taxes on. So the QDOT is a way to get money to that the non-U.S. citizen spouse without immediately having to pay estate taxes on it. And so it needs to have a trustee, an independent trustee who is based in the U.S., and it needs to have certain, the surviving spouse has to have certain privileges to the money, access to the money. The issue there is every time the income payments are estate tax free, but anytime any principal payment is then made to that non-U.S. citizen surviving spouse, that's when the estate taxes has to be paid. So it is a way to delay the estate tax, kind of the same way you would upon, if it was a U.S. citizen spouse, that estate tax would probably have to be paid at that spouse's death. In this case, it has to be paid when the spouse actually gets the money. So the idea of this trust is to maintain those assets for the next generation, take advantage of portability between the spouses, and make sure that those assets can potentially be included in the non-citizen spouse's estate at death and using their exemption amount. Now I'm going too fast through the slides. So kind of moving on now to more charitable strategies. There's this charitable remainder trust, which is the kind of the same idea as that Cupid where I was saying it's for a number of years and you get some benefit during the term of the trust before it goes to the remainder beneficiary. The charitable remainder trust is a way to put funds into the trust, get an upfront charitable deduction in the year that trust is funded, and then get income payments from that trust over the term of the trust. So you can have that for a fixed number of years, up to 20 years, or you can actually have the trust last for your lifetimes. If you're to set this up during your lifetime, you usually want to set this up with appreciated assets. So for those of you who have, a highly appreciated concentrated asset, you want to make sure you're liquidating it right away so you can get rid of that concentration without having to pay all the tax up front. A charitable remainder trust is a good way to do that. You put that highly appreciated asset in the trust. The trust is tax exempt, so it can sell the asset tax-free, and you get that charitable deduction up front. However, whenever you get those payments back from the trust over the terms, you get at least annual payments. That is when you're going to pay that capital gains tax. So you're not getting rid of the requirement to pay that capital gains tax in the sale. You're just spreading it out over a number of years, and you're avoiding it somewhat for whatever ends up going to that charity at the end of the trust term. So a charitable remainder trust can be set up a couple of ways. There's the unit trust, which is a percentage of the trust value based on a certain date every year. So if the trust value goes up, your unit trust payments go up. If the trust value drops, your unit trust payments will drop. So it'll fluctuate with the market and the value of the trust assets every year. And then there's a charitable remainder annuity trust where you get the same set payment every year. And as I said before, when those payments are made out to you, that's when you're paying that income tax on that sale of the asset that you did that first year. However, anything that goes to that charity at the end of the trust, since the charity is tax exempt, if there's anything left over, all the capital gains associated with what's left over then passes tax-free to the charity. I'm kind of talking about this as a strategy for during your lifetime, but you can also set this up for a strategy at death. So you can name who those unit trust or annuity trust beneficiaries are. They can be your kids. And so they can get an income stream over, say, 20 years and then get charity there. So it kind of allows you to set up an income stream for them instead of giving them, your beneficiaries, a lump sum up front. And the charitable trust is also going to be a very good strategy for IRA assets, because under the Secure Act now, your children probably have to liquidate those IRAs within 10 years and pay tax. If you put it into a charitable remainder unit trust with a 20-year term, now your beneficiaries are paying tax in the IRA over 20 years instead of 10 years. And then you're also giving a charity a benefit because they get whatever's left over at the end of those 20 years. And then again, here's a picture kind of how that charitable remainder trust works. So you transfer the assets into the trust sells them, reinvests them in however you want, and then pays an income stream back to you over the term of the trust or for your lifetime. And then at the end of the term of the trust or upon your death, anything that remains in that trust at that time goes tax-free to the charities. So that's why you get that charitable deduction up front, because there's some expectation that the charity is going to receive something at the end of the trust term. And then if I've kind of overwhelmed you with all those more advanced strategies up to now, something you can do that's a little bit more basic is that credit shelter trust. So this is something you just put in your will or revocable trust, where you leave assets up to the deceased spouse federal exemption amount, or if you live in a state with a state estate tax, the state exemption amount. Kind of the same idea as that SLAT. So you use the exemption amount, and then any growth in that trust between the first and second spouse's death remains outside of the surviving spouse's estate. So this allows you to lock in the exemption amount. I mean, this can be very important for if one of you dies, between now and 2026, you can lock in that 13.61 million exemption amount, plus all appreciation associated with it. So I know a lot of people are saying, well, why do I need this? Because I can use portability. The credit shelter trust, again, it gets that appreciation out of your estate. Whereas if you just use portability, that appreciation stays within the surviving spouse's estate. And so what the benefits of this trust, beyond the appreciation aspect of it, is the surviving or the deceased spouse can control where those assets go when the surviving spouse dies. So the surviving spouse gets access to those assets during his or her lifetime, but the deceased spouse is still saying, okay, upon my surviving spouse's death, I want these assets to go to my kids. And so it protects against, the surviving spouse. If you have a blended family, it makes sure the assets go to your kids and maybe not your spouse's kids. And it also protects those assets against maybe a subsequent marriage from the surviving spouse. And assets in the trust also tend to be protected from creditors. So, if you're the surviving spouse goes out and gets in a bad car accident and gets sued, those credit shelter trust assets are going to be a lot harder to reach than the assets that are in the surviving spouse's individual name. So that's something that even if you aren't going to do anything, from points 1 through 6 that I went through, I would highly recommend that at the very least you do that credit shelter trust. Put those within your estate documents and make sure that irrevocable trust is funded upon that first spouse's death. And now, since the next strategy details insurance, I'm going to pass this on to Joe.
Great job, Kate. So irrevocable life insurance trust, or ILITs, again, we love our acronyms. This is simply put, you're creating an irrevocable trust simply to own life insurance. So the trust is the owner. The trust is also the beneficiary of that life insurance policy. The donor essentially is making gifts into that ILIT each year in order to pay the premiums. If those premiums are over the $18,000 annual exemption per beneficiary of that ILIT, they have to file a gift tax return for each year that they make those contributions. Also, there's what's called a crummy notice that's given to the beneficiaries once those gifts are made each year, because they have the right to actually receive those gifts as a beneficiary of the trust. But we want to use the gifts to pay the premium, not so much to give out a distribution to the beneficiary. So the death benefit is paid to the trust, and therefore the trustee then has the ability to pay distributions to the beneficiaries as per the trust language, right? So that's the idea, is to have instant liquidity upon death that pays into this trust, which is outside of the estate, only to benefit the beneficiaries of that trust. So sometimes people use these in order to create that instant liquidity. Sometimes that liquidity helps in paying the estate tax that may be owed. It could also be used to equalize an estate with beneficiaries. So if you have a business that you own, then you're passing to, say, one of your children, and the other child or children have nothing to do with the family business, but you want to still leave them an inheritance. Sometimes leaving the life insurance in an ILIT like this will help equalize the estate. And it essentially is keeping the life insurance proceeds effectively outside of the estate. So if you own that life insurance individually and you pass away, the death benefit would then become a part of the estate, which we don't want. That's just adding essentially salt into the open wound. So we want to definitely pay or have the life insurance set up inside an ILIT so that it stays outside the estate, and then the benefits of the death benefit will pass to the beneficiaries as per the language of the trust. So we recapped quite a few different devices that you could use that are legal devices. Everything from simply gifting the annual gift exclusions of $18,000 to using the SLATs or the family limited partnerships, the Cuperts and DOTs. So we went through all of these. If you have any questions related to any one of these strategies, we would encourage you to talk to your advisor or an attorney or even your accountant about it. Accountants will certainly have a stance and weigh in as well. And we're here at Wealth Enhancement Group to help along the way to answer any of those questions as well, whether it be Kate and her advanced markets team or myself in the insurance department. So the next steps is really to think about what you want to accomplish and whether you need to get valuations done and understand what situation you're currently in. Do you need to start drafting some of these estate documents, whether they're the simple, basic, will and testamentary trust, or if you need a credit shelter trust or a QPERT or QDOT, you should start to engage with your advisor and start building the team, because it does take a team to put together a pretty advanced plan, especially for the estate tax plans that we design, and it can take many months. 12 to 18 months is pretty common for an advanced estate plan, only because if you own, say, real estate or business, those valuations take time to get, and just mapping out which best legal strategies you're going to use, whether it's going to be, credit shelter trust or if you're going to use just a simple, family limited partnership or an ILIT. It does take time to plan that out and think through all the different moving parts and which assets you're going to gift or leave or how you're going to freeze the estate. So start planning. If you're in a situation where you're federal estate tax exposure, you should certainly get a jump on that before 2026, so you might be able to use those exemptions that we have currently. So if you want, there's going to be a lot more information on our website available, everything from how the federal estate tax exemption is going to affect you to taking advantage of the annual gifting strategies. And you can see here, we're going to have lots of information for everyone on today's webinar for you to read up on. And obviously, we want you definitely to engage with your advisor here at Wealth Enhancement Group. So with that, I'm going to turn it back over to Tom for questions and answers.
Yeah, thank you very much. I want to be cognizant of everyone's time here, so I think we're only going to go through a couple questions. First one, I know this was touched on a little bit, but probably could use a little bit more clarity and in-depth information. But how does this affect a permanent resident on a green card?
So this is where that QDOT trust comes into play. So actually, the green card holder has more ability to leave things estate tax free than the U.S. citizen spouse of that green card holder. So like I said, the green card holder still gets the full federal exemption amount, so they can take advantage of the 13.61 million exemption now, or they'll have the 7 million estimated 7 million exemption in 2026 and beyond. And they can leave anything over that estate tax free, an unlimited amount estate tax free to their U.S. citizen spouse. Unfortunately, the U.S. citizen spouse, again, they can use up their entire estate tax exemption amount, but anything above that, they cannot leave it estate tax free to that green card holder. So that's when you wanted to come into planning, making gifts now, you setting up that QDOT with an attorney who is familiar with that strategy, and just making sure that you're structuring your estate away in a way that takes advantage of both spouses' full exemption amounts. So hopefully that U.S. citizen spouse doesn't have to try to use that unlimited marital deduction to pass assets to this green card spouse, because unfortunately that unlimited marital deduction doesn't exist for the U.S. to leave assets to a non-U.S. citizen spouse. So that's where planning needs to come in for those particular people.
All right, next question here. How long does Congress have to act to extend sections of the TCJA or make them quote unquote permanent?
So really they probably have until the end of 2026. Ideally they would act before the end of 2025, but we've seen, particularly in these last 2 years, where laws pass at the end of the year and they apply them retroactively to the beginning of the year. So if they did that in 2026, they could still pass a law in December, and apply it retroactively to the beginning of the year. And so they permanently locked in like today's exemption amounts. But obviously you don't want to wait until the end of 2026 to act, because you don't have time to if it ends up Congress doesn't do anything. So ideally you want to see them act sometime before the end of 2025, so you have more time, so you know what's going to happen. But really, they can even act after 2026. Maybe 2026 the exemption drops, but in 2027 they pass something. So there's always that future. You never know what they might do in the future where they'll lock in something more permanent, even if you have a couple of years with that with the dropped exemption.
I think we'll just do one more question here. If you already have a trust established, what effect will the estate tax have on it?
That depends on the type of trust that you have. So if you have a revocable trust, that is still entirely subject to estate taxes. So that will be impacted by the drop of the exemption amount in 2026. Anything in a revocable trust is included in your taxable estate. So if you don't get it out of your estate into an irrevocable trust before 2026, it will be included and taxed, potentially taxed in 2026 and beyond. Your irrevocable trust assets, under current laws, those are going to be exempt from any future estate taxes. You've already used a part of your exemption to fund those trusts, or you've used your annual exclusion amount. And so anything in an irrevocable trust should remain outside of your estate. That said, there are always some, ideal things out there floating around where maybe if you do some action with an irrevocable trust, you might pull it back into your estate, whereas right now you wouldn't. But that is something that needs to be affirmatively passed sometime in the future. So we're always keeping an eye out for potential law changes in the future. But just taking current law and the sunset in 2026, there should be no impact on those irrevocable trust assets. Those should remain outside of your estate going forward.
All right. Well, like I said, I think that's about all the time we're going to have for questions today. I want to thank Kate and Joe for joining us. Thank you guys again. I know we covered a lot of information, but I think it was really helpful to our viewers. And again, there's a lot of stuff already on our website, a lot of information about a lot of these subjects. So if you still have more questions, definitely check out our blog, check out some of our other resources we have available, or reach out to an advisor. That's probably going to be your best way to get an answer to some of these questions you might have. So thanks again for joining. Kate, Joe, thanks again for being with us. And we'll send out a recording of this in the next couple of days, and we hope to see you all at the next webinar. Thank you.